Money FM 89.3, best of breakfast. The US Market Update with Money FM 89.3.
Good morning. Welcome to the US Markets Wrap. And we've got stocks finishing lower, ending a 3-day winning streak as big tech shares pulled back. The broad S&P 500 was slightly lower by 0.2%, finishing at 5,937. The tech-heavy Nasdaq dropped 0.9%, and we have the Dow Jones Industrial Average losing 0.2%. That's about 68 points to 43,153. For more insights, we are joined by Dave Sekera. He is the Chief US Market Strategist for Morningstar Research Services. Good morning, Dave, and Happy New Year to you. How are you doing today?
I'm doing well. Good morning.
Always great to have you on, and we have a lot to talk about. Let's start first with what's the latest in the markets. And we are seeing some of the major averages giving up gains from earlier in the week. So walk us through what's happening here, because we did get some pretty good earnings coming through from the banks. What's worrying investors right now?
Yeah, I mean, the banks put up really spectacular numbers, so that was a big portion of the move up, yesterday. Today is probably just a little bit of a retrenchment. Some people probably taking some gains, off the table, locking that in. Generally speaking, we think that the market is getting to be a little on the high side here. Currently trades at a 4% premium to composite of our fair values. So again, not necessarily in the range that I consider to be specifically overvalued. I still think investors should market weight, U.S. equities here, but I am becoming, increasingly, more cautious.
All right, let's talk about where you are optimistic about. And of course, worth talking about technology, which had a pretty good run in the past year or so. Worth noting as well, Apple was one of the big losers overnight, down 4%. And it seems like they are losing ground in one of the biggest markets, China. What do you take away from the latest numbers coming through from a report from Canalys, which suggests that Apple has fallen to third place in terms of smartphones sold in China?
Yeah, well, I mean, first of all, I just have to acknowledge, we think that Apple stock in and of itself is overvalued. It trades about a 20% premium over our fair value estimate. That's enough to put it in 2-star territory. We rate stars, 1 through 5, or rate stocks 1 through 5 stars. 1-star stocks are those that are most, overvalued. 5-star are the most undervalued. So in this case, we do think that the stock, even before today's sell-off was, already overvalued. So I think today it's just really the acknowledgement from the market that they need to, price in that Apple is losing market share, in China to domestic competitors. And of course, that's actually been, a large part of our bearish outlook on that company.
All right, talking about stuff that's overvalued. Where are you when it comes to Tesla? It's one of the Max 7, of course. And worth noting, Elon Musk and incoming President Donald Trump are BFFs. So how do you factor that as a potential support or maybe even tailwind for his business?
Yeah, I mean, Tesla's had a huge run up since the presidential election. I think the stock is up about 70%, just since the beginning of November. So it's run up so much at this point. It's now actually double our $210, per share valuation. And in fact, when I look at the, price of Tesla today, look at how that's traded, over time compared to our fair value. This is one of the most overvalued levels I think that I've ever seen the stock, at this point. And really, in my view, I think it's just purely a speculative run at this point. Really, nothing has actually changed from a fundamental point of view. So really, like you said, at this point, it's just, a speculative bet what may or may not occur, with Elon working, much more closely with President Trump going forward.
Now, of course, it's still facing a lot of competition in China as well. So not exactly smooth sailing on that front, on the international markets at least. All right, let's talk about what is going to be playing out in the coming days. And that's Donald Trump coming into the White House. What is going to be the impact on markets? What's been priced in already?
We shall see exactly, what happens. I think, the biggest risk, of course, and the biggest wild card to the market next week is, what Trump may or may not do regarding the implementation of tariffs. Of course, really, I'm just waiting to see, how much of that tariff talk was campaign trail rhetoric versus how much is he going to actually implement. And of course, then it also depends on, what geographic regions, he implements tariffs against, what other areas maybe he excludes from it, what products are included in those tariffs, what products are excluded. So again, I don't think anyone really has, a good knowledge right now of exactly what he's going to do and how quickly he's going to roll that out. So a lot of people, myself included, holding our breaths to see, what exactly comes to fruition.
Yeah, besides tariffs, it's also promised to loosen regulations for businesses, tax cuts as well. Is there a way to play off this? And we saw this play out in his first term as well.
Yeah, so I mean, it's just a similar playbook as his first term, as president. So, if we see, the cut to the individual income taxes, that of course would bolster, consumer spending in the short term, which would be a positive for the U.S. economy. And if he cuts, corporate tax rates, that would then bolster, stock market valuations. So we could see some upside there. But really, at this point, I think the biggest focus is going to be on two different areas. One, just where is he going to be looking, to cut government spending? I think that's going to be a much greater focus now than it was in his first term. And then secondly, as they're looking through and cutting some of the regulations, I think one of the biggest changes that we expect are really a large increase in mergers and acquisitions this year. M&A had been relatively low for the past couple of years, and especially low in the technology sector. That was one area where regulators were especially restrictive in allowing deals to be completed. So I could see a lot of small cap and maybe even some mid cap technology names with some of the larger and some of the mega cap names, taking a look at running it, buying them out.
Yeah, considering the economic backdrop, we have at least that going well for Donald Trump. It seems like we've got a few pockets of resilience. The labor market's still quite strong. And going by some of the earnings coming through, we are looking at a rather optimistic picture so far. What's your take on where things are going in 2025?
Well, with the market trading at that 4% premium, I think for the first half of the year, we'll probably be likely pretty range bound. I'm not looking for much principal appreciation in the U.S. markets, until earnings catch up to where valuations are today. And that's probably not going to be until the second half of the year. That's one of the reasons I actually like, high dividend paying stocks today, stocks that you can buy at a pretty good margin of safety from their intrinsic valuation. Depending on the stock, you can capture anywhere from 4 to 6% dividend yields. So I think these are the kind of stocks that you can get paid while you wait for the market to start moving up in the second half of the year. And if we do have any kind of pullback, these are also the type of stocks that probably hold their value better to the downside.
All right, let's jump into some of those names and some of those places to look at. You've got an overweight call on real estate. Walk us through the thinking here.
Yeah, well, real estate has actually been the most hated asset class on Wall Street for at least the last year and a half, if not 2 years. Started to make a little bit of a bounce back in the third quarter, but then gave up those gains in the fourth quarter. Really, I just think that this is an area that the market, because there's such negative sentiment there, we see a lot of opportunities. The sector overall trades at an 11% discount to fair value. But as an area, I do think you need to be choosy with individual stocks that you're buying. I'd much prefer staying with much more defensive-oriented plays within the real estate sector, things that might be tied to storage or healthcare, medical office buildings. Plays like that I think are much more attractive. I'd still steer clear of urban office space. That's one area where I still see more downside risk potentially coming.
All right, let's take a look at what you're, I suppose, more underweight on. And you've got the consumer in focus. And that's interesting because we've been hearing about how the U.S. consumer has been quite resilient. And Donald Trump, of course, will be trying to encourage people to spend and make it a more business-friendly environment. How does that play into this thinking here?
Yeah, the consumer cyclical sector trades at a 19% premium to our fair values. That I think is the highest premium it's ever traded. And of course, a lot of that is due just to Tesla, which trades at double our fair value. Tesla by market cap as the second largest stock within that sector, largest stock being Amazon. And even Amazon, with as much as it's run up, year to date, that's also starting to get pretty pricey in our view. Other companies like Home Depot, we think the market is pricing just way too high of a premium for the long-term intrinsic value of that company. So that is one sector we're very concerned about. Consumer spending has been holding up, but we do expect that the rate of economic growth in the U.S. is going to slow over the next 2 quarters sequentially. So I wouldn't be surprised to see consumers, starting to tighten the belt and be a little bit, less willing to pull their wallet out.
All right, the retail earnings will be one to watch as we see them unfold in the coming weeks. We've been in conversation with Dave Sekera. He is the Chief US Market Strategist for Morningstar Research Services. Dave, thanks for your time and insights today.
Oh, well, thank you very much, and I hope you have a great rest of your day.
You too, Dave. Stay with Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.